interest rates, when interest rates come down, now most people think when interest rates come down, the prices are going to go up because people can afford more, but that's not true.
I am not always a huge fan of Grant Cardone, but this time he is not wrong. In today's video, we are going to break down why Bank of Canada is cutting rates and what it means for you and me. So let's get started. If you are new to this channel, my name is Navjot and I'm on a mission to retire 1 million immigrants with $5 million. And if you want to be part of this journey, all you need to do is subscribe to the channel. And I promise you that I'll be bringing a lot of good content that will make all of us a lot of money. So, is the recession cancelled? We'll talk about why is Bank of Canada cutting rates. This is the third time that they have cut in third successive announcements. Then we'll talk about why is the real estate market still slowing down despite the rate cuts. And finally, we'll be talking about with the rate cuts happening, with variable rates going down, is it time to take a variable rate versus a fixed rate if you are buying a home in the next few months? Now, before we talk about why Bank of Canada is cutting rates, we first need to understand how recessions occur and is the recession actually cancelled. So when interest rates went up, the problem was that the access to money was reduced. And it's not just the mortgage rates getting increased and therefore the eligibility is not enough for most people to buy homes, or it's not just the rents going up, or it's not just the grocery going up because the inflation was high or the oil prices. It is also access to money for the employers, for companies, for self-employed people, for small businesses. All these people also suffer when interest rates go up. And the reason for that is because the disposable income that is available for people to do haircuts, for people to buy expensive grocery, for people to visit restaurants and have meals outside, go to amusement parks, travel, all that also goes down, and that impacts businesses. High interest rates also mean that line of credits are expensive and therefore their interest expense has increased, and a lot of manufacturing sector is almost always dependent on credit. Funds available for venture capitalists also dry up, and that reduces the amount of innovation that's happening. Everyone loses. And that's what I mean when I say when interest rates go up, access to money overall for businesses and for people go down. What that does is business growth actually reduces. Of course, if we are not buying cameras, if we are not traveling, all these companies will make less money, and we have seen so many companies suffer in the last few quarters. That reduces the business confidence and therefore there are more layoffs, and that actually becomes a cycle, and that's where the recession comes in, where it becomes a cycle. And because the business confidence and business growth is curtailed, there are layoffs, hence reducing the disposable income even further. That impacts the businesses even more, and that leads to more layoffs. In very simple terms, that's what a recession is. We see the unemployment rates are pretty high, especially amongst new immigrants. One of the stats that I read, and I have actually done those numbers as well in one of the videos earlier, that there are about 30 to 40% people who are coming to Canada, who have come in the last 1 year. They don't have jobs, or they are only doing part-time jobs. They don't have enough full-time jobs. Overall unemployment numbers across Canada is about 6.4%, which is pretty high. There are more job cuts happening every single day, and this is not helping the economy. However, if you look at the overall economy, it's grown by 2.1% and it has actually surpassed their estimates for the quarter. Now, the technical definition of a recession is that GDP has to go down in 2 consecutive quarters, and only then the economy can be tagged as being in recession. So the question is, while everything is pointing towards we being in recession, why is the economy growing by 2.1%? And the answer to that is population. Canada's population has increased by 3.2%, which is a record in itself. And most of this population growth has come from new people coming into Canada, which is basically immigration. If there was no new immigration that happened in the last 1 year, the population growth would have been only 1.2%, and therefore the GDP would have actually been negative. Because these new 1.2 million people that have been added to the economy, they will buy something, they will rent, they will pay a mortgage, they will buy cars, they will buy grocery, even though they are not able to buy at the same extent because of inflation and lack of jobs, but they would still consume resources, and that would fuel the economy. In fact, if you weed out the impact of population and you only look at Canadian per capita GDP, that has actually declined for many quarters. If you look at Q3 2022, Q4 2022, Q1, Q2, Q3, Q4, every single time the yellow bar that you see, that has been declining, and that's the per capita real GDP growth if you exclude population from it. And this has been story throughout 2024 as well, where the real GDP is actually going into negative. So even though it looks like we are not in a recession, if you look at the GDP numbers, and the media might say that, oh, we are going over estimates, that's not true. If you look at the per capita GDP, that's actually declining, and that's the definition of a recession. And that's also a big reason why Bank of Canada is reversing the trend by reducing the interest rates again. And now, of course, inflation has come under control. It's at 2.5%. That doesn't mean things have gotten cheaper. It's still 2.5% more expensive than it was in the last trailing 12 months. But essentially, Bank of Canada is trying to spur more access to money in the economy, because when interest rates go down, people have more access to money. Businesses have more access to money to reinvest in their businesses. They get access to line of credits, which are a lot cheaper. Like I explained in the previous slide, the access to money goes up. There are more people who are able to consume more. This improves business growth, the business confidence increases, and that actually impacts layoffs to go down. And this will give more disposable income to people who will then spend on restaurants, spend on travel, and that would spur more growth with the businesses, and therefore they'll hire more. And that's the trend reversal that Bank of Canada and the government is hoping for. Now, as soon as Bank of Canada reduced interest rates 3 times in a row, people have been saying, and there have been news articles that are saying that Canadian housing prices could rise up to 6% in steady fall market. Experts predict Toronto's housing market will ramp up in the fall as prices and rates continue to drop, and BC housing market expected to rebound after sluggish sales. There are so many articles saying that. However, the real estate continues to go down. If you look at the numbers for last month across Ontario, this is Ontario numbers, even though the number of units have sold, and that's where people are getting misled. Yes, there are more units being sold versus last year. It's 5.5% more houses being sold, but that doesn't mean that the prices have actually increased. The prices, in fact, even month on month, have actually declined across all asset classes except maybe for rent, which is stable. Even if you look at year-on-year change, you will see that there is a massive decline. 4 to 5% decline is pretty big in real estate, and this is despite the interest rates coming down versus last year. And this to me makes sense. In fact, I think that the real estate market will actually not recover for the next 6 to 8 months. And this is one of those very few moments when I actually agree with Grant Cardone and what he has to say about interest rate decline and the housing market.
Interest rates, when interest rates come down, now most people think when interest rates come down, the prices are going to go up because people can afford more, but that's not true.
This is exactly what we have seen in the last few months. If you look at the Ontario market, there are 18.5% more new listings versus last year. Every month, there are more new homes coming on the market, and the buyers have not yet recovered. Now, just because Bank of Canada has reduced rates in the last 3 months, that doesn't mean that people are out of the woods. That doesn't mean that hiring freezes are not happening. That doesn't mean that layoffs are not happening. That doesn't mean that IT has completely recovered. That doesn't mean that banks have completely recovered and therefore there's more disposable income in the market. Things don't move as quickly. This is real life and things always take time to recover. Now in housing, there is a really good metric called SNLR, which is basically sales to new listing ratios. That is a ratio between the amount of sales, the number of homes that are being sold versus the new listings that are coming into the market. If you look at this, Ontario is at a record low of 40%. That basically means that for every 4 homes that are being sold right now in Ontario, there are 10 that are coming into the market. We have never had this kind of a market in a very long time in Ontario, and Ontario is actually the worst hit at 40%. This metric actually says that at least in July, we were in a buyer's market, even though some of the other markets are not that much of a buyer's market, but it's still a lot better than what you have seen in the last few years. If you look at Ontario specifically and by market, Toronto, Mississauga, Brampton, London. Now, generally, if this ratio is under 40%, it's a buyer's market. 40 to 60% is a balanced market. And if the ratio is over 60%, that's when it becomes a seller's market that we have seen in the last few years. So like Grant Cardone said, when the interest rates come down, there are more sellers who go into the market because they become impatient. They want access to money. They have been stuck into properties that were very expensive and they want to dispose of them. And therefore, there are a lot more listings that come to market in anticipation that there'll be more buyers. But buyer situations don't change so quickly and it takes time for them to come into the market. And that's the reason why, because of the supply and demand gap, with supply going up and demand staying as is, you see a buyer's market. Now, what Grant Cardone said is very much true for US, a little bit true for Canada, and there's one big difference. Let's go back to that clip and get the full context of what Grant Cardone meant.
The prices are going to go up because people can afford more, but that's not true. Because about 60% of all the loans in America are either paid for in cash, or they have a very, very low loan, or they have 3% money. So a lot of people trapped in a house right now. Interest rates have to breach 4, maybe 4.5. When they breach, then Vlad will be like, I'm going to sell my house now because now I can move to the house I want. And the housing market is dependent upon not new buyers, first-time buyers. Existing buyers that are trading.
Now, the last few words is the difference between US and Canada. Home prices in US are expected to not return to the same levels in the next 2 years. However, Canada is different because there's so much new net immigration that has happened in the last 2 years. If you just for context, from 2016 to 2021, there were 1.3 million new immigrants that entered Canada. In 2022 and 2023 alone, there were more than 1.3 million immigrants that came. And all of these people are paying very high rents and they would all want to get into the market. And therefore, while I agree that when interest rates are coming down, the impact will not be felt, but the housing market in Canada is likely to recover a lot faster than it would in the US. And the biggest variable for that will be immigration. Now, I spent hours making this video and consuming a lot of content, and that's the reason why I had that clip, because I saw every single economist, every single business person, every single politician, what are they saying about this particular economy. Now, the one thing that I did not see is what is Remax saying, what are these realtors saying, because even though I do respect a lot of the realtors and they do a lot of hard work, they don't necessarily understand how the economy works, and that's okay because that's not their job. But I'll summarize what I learned in my hours of research of looking at various economists and what the market is saying and what some of the people who have lived through 3 or 4 recessions have to say about this particular market. So now that the interest rates are going down, there will be much more new listings, and that we have already seen will continue to increase in anticipation of a housing rebound. So there will be more sellers who will be coming into the market. There will be more people who were in distress. They'll be coming into the market and selling their homes. That's number one. Yes, there will be more people who will be ready to buy a home now. They have been on the sidelines because the interest rates were very high, and they will all move into the market. We have seen that in my client pool that has actually increased in the last 2 months, and the number of units sold will be a lot higher. However, it will not outpace the number of new listings, and that we saw in the SNLR ratio that we saw, which is under 40% for most places in Ontario. So yes, there will be more buyers in the market in the next 4 to 6 months. However, there will be much more listings, record number of listings that will be coming on the market, and that could mean that the real estate market continues to slow down or at least stagnates for the next few months. Now, Bank of Canada has made it very clear that there will be 3 to 4 rate cuts expected until Q1 of 2025. However, unemployment and business confidence and growth will take time to rebound. And I think that spring and summer of 2025 is when the market will start to rebound and people will find more stability so that they can go into the market and buy with confidence. Now, if you are someone who is buying your first home in the next 6 months, the biggest question that you will have is, with the interest rates coming down, whether to go for a variable rate now, because when the interest rates come down, the payments will come down, or to go for a fixed rate. Now, to understand this, let's look at what the banks are predicting when it comes to variable rates and where they think the variable rates will land in 2025. So this is basically a table where BMO, CIBC, National Bank, all the top 6 banks are giving their projections, and you'll see that all the projections range from about 2.5% with TD, which is the most bullish projection that I've seen, all the way to about 3.25%, with Scotiabank. Now, all these numbers that you see are policy rates, which is different from variable rates. But what this means is, if I translate that into what we understand, is that the variable rates will range from 3.75% if you were to go with TD's estimation to 4.5% if you are to go with Scotiabank's estimation. So everyone is saying that the rates will be around that 4% mark. Now, if you look at the last 20 years of data from 2000 to 2019 before the pandemic, the variable rates have been on average at 3.71%, sometimes higher, sometimes lower, depending on the market. This includes a couple of recessions, oil crisis, 2008 subprime crisis, but the variable rates in Canada have been in the range of 3.7, and that's the expectation that most banks also have. So I think that these projections are extremely fair, and I would agree that we will see a less than 4% rate by end of 2025. Now, given this context that variable rates will drop to about, let's say, 3.75% by end of next year, Does it make sense to still go for a fixed rate which is at 4.5 to 4.6% or go for a variable rate which is much higher at 5.5% in anticipation that it will drop to 3.75% and therefore you will save more interest? Numbers don't lie. The way we are making this decision is with numbers and not with emotion or anticipation, and I'll show you how we are doing these calculations for our clients. But first, let's understand the variable and fixed rates. Now, you'll be surprised to know, especially if you have come in the last 4 years in Canada, you'll be surprised to know that fixed rates are actually always a lot higher than variable rates. That doesn't seem like, something that has happened in the last, couple of years, but just know that what's happened in 2023 and 2024, it's only happened 6 times in the last 50 years since 1975 that fixed rates have been lower than variable rates. It happened in late 70s and 80s. It happened around the recession in 89, and then it happened in the last 2 years. So what we are seeing today is such a rare occurrence. It has only happened 6 years in the last 50 years, and 2 of those years have been the last 2 years. So what you are seeing right now is not normal. If you look at the data between 2000 to 2019, all the years the variable rate was in fact lower than the fixed rate, and the variable rate on average was 3.71%, whereas the fixed rate was 5.94%. So when people say that because variable rates are coming down, fixed rates will also come down, that might be true in the short run, but long term, when variable rates come down, that basically means that the economy will start to improve, and when that happens, fixed rates actually go up. Let me explain you why that happens. Fixed rates go up and down depending on where the investor trust is. Now, there are 2 types of situations when it comes to that. Number 1 is when investors trust the government more than equity markets, and number 2 is when the government is trusted less than the equity market. So people actually want to invest in the stock market because they don't have a lot of trust on the government. In the first scenario, investors prefer to invest in the bond market because they feel that there's too much variability in the stock market and their money will be a lot safer in the government bonds. And that increases the demand for bonds, and with higher demand, the yield on those bonds reduces. And when the bond yield goes down, fixed rates go down. On the other hand, when the market is going well, investors prefer to invest in the equity markets. Demand for bond decreases and therefore the return on that increases, and that increases the fixed rates. Let me explain this with an example. Now let's assume the 2008 subprime crisis, when the stock market actually crashed because there were so many banks that failed. Investors were not confident of putting their money into the equity markets, and therefore they started investing in the bond market. The demand for bonds went up, the yield went down, and therefore the fixed rates also started dropping in the subprime crisis. Similar thing happened in 2014 when the oil crashed and there was much more volatility in the stock market, and similar thing happened there as well, where the fixed rates started to come down. Exact same thing happened just before COVID and during the first few months of COVID, when the confidence of people just was not there in the equity markets because we were very close to a recession before the pandemic. People have forgotten that, but in 2019 there was a very high chance that we will go into a recession in that year or the next year, and then COVID hit and everything changed, and even then we saw that the bond yields reduced and therefore the fixed rates actually reduced a lot. If you look at 2015 to 2020, when there was a bull market, everything was going up, the real estate was going up, people were flipping properties, people were making a lot of money, businesses were enjoying low interest rates when there's a bull market, and therefore the demand for government bonds reduced, which increased the yield of the government bonds, and therefore the fixed rate started to go up. Same thing happened during the pandemic when there was excess money in the economy, people were investing in the stock market, crypto, NFT craze came, there was a bull market, and therefore you also saw the fixed rates going up. And in the last few months, in fact almost a year, now that there's a high volatility, there's war happening, all those factors are now contributing for people to have less trust on the equity markets again, and they want to secure their money into government bonds, and these institutional investors have gone back to the bond market, and therefore the fixed rates have started to come down. Now this trend may continue for another year or so when the fixed rates will start to come down as the variable rates are coming down, but long term, when there's a bull market, which will come in 2025, end of 2026, 2027, when there's a bull market, fixed rates will start to go up, and then we'll again see variable rates lower than fixed rates. I know this is very confusing to understand, but just know this: when the equity market, when the stock market is stable and it's a bull market, there's a very high chance that the fixed rates will start to go up. And when there's a recession, the fixed rates will go down. It has nothing to do with Bank of Canada. It has nothing to do with the variable rates. It has everything to do with where the investor trust lies. That's exactly the reason why in the last 20 years, variable rates have been significantly lower than the fixed rates, and what's happening in the last 2 years is not a very common occurrence. Given this context, the question still remains, should you go for a variable rate or a fixed rate? And let's do the numbers on that. Now, a couple of weeks ago, I created this Excel for one of my clients who was taking a mortgage from me, and we did the calculation on fixed rates. The purchase price on this home is $860,000 and the client is doing 10% down payment. So their mortgage payment at 4.6% interest rate is coming out to 4461. It's a 3-year fixed interest rate. So for 3 years, the amount of payments that will be made will be about $160,000. Now, of course, the question was whether to go for a variable rate or a fixed rate. So we compared this against the variable rate. Now, variable rate from this month onwards will be 5.5%, which is prime, which is 6.45 minus 0.95 to 1%. Let's take 5.5%. The payment will be 4870, which is about $400 higher than what it would be if you take a 3-year fixed. However, let's assume that every 2 months, the interest rate actually declines by 0.25. So in November, it declines to 5.25%. By January next year, it's at 5%. We are taking a few assumptions here. February and March is 4.7, 4.5, 4.25, 4, and then it stagnates by end of 2025 at 3.75%. If you calculate the monthly payments on that, taking these interest rates into account, you would see that your payments are reducing from 4870 all the way to 4090, and overall you will be paying $8,000 less interest. If the interest rates don't decline as the banks are predicting it to, you might end up spending the same amount of interest on a variable rate as you would on a fixed rate. So the deciding factor for this particular conversation is it depends on your situation. Can you afford the $400 payment today? Do you believe in these projections? Are you going to break your mortgage within a couple of years? Does the variability in payment stress you out and you would rather want a fixed amount to be going out of your bank account for the next 3 years? Your situation can be very different from my situation, and therefore the advice cannot be uniform. So if you are someone who is buying a home in the next 6 months, make sure to book a call with the team so that we can understand your situation and guide you accordingly. Now, even if you don't want to book a call, there is a first-time home buyer class that I'm organizing on September 18th so that you understand the process and the pitfalls to avoid. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.